According to a Bloomberg report dated October 14th, the Stanbic Group, which is the largest financial institution in Africa, it's a South African bank, through their Kenyan subsidiary, which is Stanbic Holdings, are in talks to acquire the NCBA Group. The bank still hasn't yet made an official communication, but in this video, we are going to look at a possible scenario. How would things look like? What would be the impact on the stock market? Because the market has already reacted. And we are also going to base our judgment on other acquisitions that have been made before. We are going to look at Bamburi Cement because it was acquired this year. The acquisition was finalized this year. And we're also going to have a look at KCB because KCB acquired the National Bank of Kenya in 2019. The first scenario is in terms of the total assets. So these are the top 4 banks in Kenya as of 2024. The assets for these banks have increased because we are now in 2025. So I'm just using the data for 2024. You can see that the number 1 bank in Kenya is KCB Group in terms of assets, which was 1.96 trillion. Equity comes in as number 2 with 1.8 trillion. I have rounded up these numbers. Then we have COP that comes in 3rd, and 4th we have NCBA. Now, if NCBA was to merge, if it was to merge with Stanbic, then we would add up their assets so that KCB is still number 1 with 1.96 trillion in terms of assets. Equity will come in number 2. Then now we will have Stanbic plus NCBA, the merged entity, will come in number 3. And this is actually in line with what the Standard Bank Group had in mind back in 2023. They had a vision of becoming part of the top 3 banks in the East African region. And we know that Kenya is a financial hub in East Africa. Now let's have a look at the NCBA stock because the market has already reacted, especially if you're a stock investor here. This is how the NCBA stock has been performing for the last 3 months. You can see that for the last 3 months at a time like this, the stock was going for 63 shillings. 63 shillings. And this was back in August, around August there. And at around September, when they made the announcement that they were going to be paying out dividends, you can see that the price of the stock went from 65 shillings. It started going up to 66 shillings. It went up to as high as 74 shillings and 75 cents. So this was at the peak. But once the date for you owning the stock so that you receive the dividends had passed, you can see that the price of the stock started to go down from 74 to 72 to even 68 shillings. And the price stabilized at 68 shillings to 70 there, 68, 69. But on October 13th, okay, the news was made available on 14th, you can see that the price of the stock moved from 69.5 shillings, 69.5 to as high as 83.25 shillings. And this wasn't even the highest price. You can see that the highest price for the last 1 month is 88 shillings and 50 cents. We have an investor who bought this share at 88 shillings and 50 cents. So that sharp increment is as a result of this news. There is optimism in the market because what happens is this. We have 2 banks here. The bank or the institution that is being bought, there's usually that expectation from investors that the other company that is going to buy this company, the shares of this company, are going to pay you a premium price. This is what happened with Bamburi Cement. When you go and look at the last price, the last trading price before the stock was suspended from trading in the stock market, it was going for 54 shillings. And that was the highest price within those 3 months. But the investors of Bamburi Cement, the company that bought Bamburi Cement shares, which was Amson's Group, it's a Tanzanian company, they announced that they were going to pay the stock owners of Bamburi Cement 65 shillings. So if you bought that stock at 54, they received 65 shillings. So that's a difference of 65 shillings minus 55, that's around 11 shillings. You can imagine if you owned 1,000 stocks, that is 11,000 extra. If you owned 1 million stocks, that's 11 million shillings. So that expectation that the company, the shares that are going to be sold, the company that is going to be bought is going to be sold at a premium is what is driving this price to go up to 83 shillings. A jump from 69 to 88, that's a huge number. That's like 20 shillings extra. So this is the NCBA stock, and this is typical of any stock that is being sold off. Now, the question that you might have is what might happen to the other stock, the company that is buying this stock. So let's have a look at Stanbic. This is how the Stanbic stock has been behaving for the last 3 months. You can see that the stock was going for 173 shillings and 50 cents. That was in July at a time like this. And the price of the stock started to go up to as high as 185 shillings and 25 cents. And this is when they made the announcement that they were going to be paying out dividends. But what you'll notice is that the price of the stock, just stabilized at around 182, 183, 184, 179, 180 until 30th September. Now, the information on this sale, or rather the information on this acquisition, was not yet made public by Bloomberg, but you can see that the price went up. I'm not insinuating anything, but let's look at 13th October. You can see that the stock price was around 198 shillings here. And the price of that stock has played around 199, 198 shillings, 199, 198 shillings. So you can see that there's a plateau there. The price of the stock has not sharply gone up like the NCBA stock. It has stabilized. So the reason why this is happening is because when you look at other acquisitions, especially the company that buys the stock, there's usually a lot of uncertainty. Uncertainty in that, what if this acquisition works? What if this acquisition doesn't work? There are 3 scenarios that explain this. One is that when a stock is being bought, in this case, assuming that Stanbic goes ahead and buys NCBA shares, the NCBA shareholders can be paid in cash. So they are the ones who are receiving this money. So they are the ones who stand to win. If that happens, then Stanbic or any other entity that is buying this stock will have to dig deep into their pockets, into their earnings, to pay out these investors. So the earnings per share reduces, because out of these earnings, out of this income that this company makes, they have to take out that bit and pay out these investors. So there might be a shock in terms of the dividend payout. It might happen, it might not happen. It depends on the source of income that they're going to use. Some can even use debts. But the point is that a payout from the earnings that are usually used to pay out shareholders can reduce. It can or it cannot reduce, but because of that uncertainty, you're not sure, should I still own this stock? Now, whoever owns this stock that is being bought, in this case, let's assume it's NCBA, they can be paid out not in cash, but through a shares swap. They can say for every 5 shares that you own, in this case, let's say NCBA, you're going to receive 1 share at Stanbic, or for every 10 shares that you own, or every 3 shares that you own, there's that swap of shares. So you're not paid money. You're not paid in cash, or it can be a mix of the two where you're paid some cash and you also get some stocks. Now for the other scenario, the one that I explained where there can be a shares swap, think of it this way. Or let me just use an actual example, the KCB stock, just to illustrate this. In 2019, KCB acquired NBK, the National Bank of Kenya. So what happened is that whoever owned NBK, because these 2 companies were listed in the stock exchange market, both KCB and NBK were listed there. The shareholders of NBK were not paid in cash. They were paid through a shares swap. So for every 10 shares that you owned at NBK, you received 1 share at KCB. 1.4 billion shares at NBK were bought. But remember, there is that share swap ratio. For every 10 shares that you own at NBK, you're going to receive 1 KCB shares. one KCB share. So when you do the calculation, we have 147 million shares that were issued at KCB. So we've taken the shares from this company and we've added these shares to KCB. Now that is what is called shares dilution. You have diluted the existing shares. Now we have more shares. So if you are a shareholder, you are a majority shareholder at KCB, and you had voting rights, higher voting rights. The more the shares that you own, the more your voting rights. So you can see that because your shares are now less, your voting rights have reduced. Unless you buy more KCB shares. So that is another uncertainty. That is another uncertainty that makes the price of the stock that is buying the other stock reduce. And it's exactly the same scenario that happened with NCBA. NCBA wasn't NCBA. NCBA was a company that was formed because two companies merged, NIC and the CBA bank. And it was done through a similar process where shares were swapped. So that's another contributing factor that might lead to uncertainty. In fact, when you look at the history of the Standard Bank Group, the South African entity, whenever they buy shares or whenever they acquire another company, their shares usually just dip slightly. So that's an expectation that the value of the share can go down slightly. The value of the share can stabilize as we wait to see whether this acquisition is going to be a good acquisition, a good prospect. When you look at the KCB stock back in 2019, when they made this announcement that they were going to acquire the National Bank of Kenya, by the way, the National Bank of Kenya was sold to Access Bank, which is a Nigerian financial institution, because they're looking forward to penetrate the East African market. So KCB sold NBK to Access Bank earlier on this year. But when you look at how the KCB stock behaved, it's just behaving how the Stanbic stock is behaving right now. The price for the stock was around 38 to 40 shillings. It just stabilized there. There wasn't any sharp increment. There wasn't any sharp decrement. It was just playing around there. The other question that you might have is, why would a bank want to acquire another bank? Now, for the Standard Bank Group, their goal was to be part of the top 3 banks in East Africa. And if this happens, this is going to be true. The benefit of being a larger institution, not even just a bank, for you to have a factory that is bigger, is that you benefit from the economies of scale. It's easier for a bigger institution to have access to capital, to negotiate debts. Plus, it saves on costs. In as much as during this period, assuming that these two entities integrate, there's going to be that additional cost of, just trying to streamline everything, which again leads to uncertainty as to why the price of the stock is stable. But in the long term, in the long run, a bigger institution benefits from lower costs. So they're able to save and make more. So a big institution is more valuable. That's what I would say. You can also agree with me on that, right? There are certain risks that you have to have in mind, especially if you are a stock investor, because during this period, you can see the price for the NCBA stock has gone up, and you might want to own this stock so that you might benefit from any premium that might be paid, assuming it won't be a share swap. And if it's a share swap, you can also benefit from that. The risk to that is that you've seen that the price for NCBA stock has gone to as high as 88 shillings. What if Stanbic Bank goes ahead and does this acquisition and pays a lower price? So you bought the stock at 88. What if they pay 75 shillings? Or what if they pay 70 shillings? But it has to be a premium. It has to be a premium above the market. So what if they go ahead and pay this 88 shillings? Have you benefited? Now, the other side to that is that what if they go ahead and pay 99 shillings? What if they go ahead and pay 95 shillings? I don't have such information, but this is just to jog up your mind. What if that's the case? You benefit. So there's that risk. And this is the time where we have traders. We have traders who are thinking short term. Their work is to buy and sell, which is another avenue of making money in the stock market. So you have to be aware of those risks. They might benefit you, they might go against you depending on when you buy the stock. The other risk is post-acquisition performance. what if it doesn't work out as they thought? But for you to gauge that, you have to think of it long term. What if it works out? What are your thoughts on this acquisition if it was to go through? And generally, what do you think of banks consolidating with other banks? Because this is what happened with KCB, this is what happened with NCBA, and even how NCBA was formed. And also, we had the Central Bank of Kenya increase the core capital for Kenyan banks from 1 billion to 10 billion last year. And we have some banks, 11 banks to be specific, that are having an issue raising this 10 billion within that time frame. So what if some of these banks end up consolidating? Because that's another angle to look at it. So what are your thoughts generally on banks merging? I'd love to know your thoughts in the comments.